This video is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial professional.
All right, let's dive right in. A brand new inflation report just dropped, and honestly, the numbers have caught pretty much everyone by surprise. So today, we're going to unpack the official story, take a look at some really conflicting signals, and figure out what all this actually means for the economy's future.
Okay, so here's the big number everyone's talking about, 2.7%. The latest CPI report shows a pretty significant drop in inflation. Now, to be clear, this doesn't mean prices are actually falling. It just means they're rising a little more slowly than before. In this figure, it completely defied what everyone was expecting. I mean, the previous rate was 3.0%, and all the economists were predicting it would actually go up to 3.1%. But instead, we got this really substantial drop. It definitely caught a lot of people off guard.
But, we have to put that 2.7% into perspective. Sure, it's an improvement, and that's good news, but it's still way above the Federal Reserve's target of 2.0%. In fact, inflation has been stubbornly stuck above that goal for 5 years now.
So what's the Fed's official line on all this? Well, they're basically arguing that the whole problem is just temporary and that they've got it under control. The main argument, which is coming from Fed Chair Jerome Powell himself, is that recent tariffs are the big culprit here. He's really framing this as, not a long-term trend, but just a temporary, one-time price increase that sort of artificially pushed the numbers up back in 2025.
So if we break down their public rationale, it's pretty simple. They're saying the tariff thing was temporary. They're confident inflation will cool off next year, and because of that, they're now shifting their main focus over to the labor market.
Okay, but here's where it gets really interesting, kind of like a puzzle. The Fed's actions seem to completely contradict what they're saying. When you actually look at their policies, what they're doing, a totally different story starts to emerge. So this is the crucial point, right? This massive contradiction. On one hand, their stated goal is to fight inflation, to get it back down to that 2% target. But on the other hand, their recent actions, like cutting interest rates and printing more money, are things that traditionally cause inflation.
And listen, we're not talking about a small amount of money here. The Fed has literally turned the money printers back on, and they're starting at a rate of $40 billion a month. So that raises a pretty fair question, doesn't it? How can you be serious about fighting inflation while you're actively doing the very things that cause it?
Well, all of this leads some analysts to a pretty stark conclusion. They're basically saying that the official 2.7% inflation rate is, and I'm quoting here, a wild fantasy. The whole argument is that the government might actually have a very strong incentive to understate what the true rate of inflation really is.
So let's just walk through the logic here for a second. The money supply is actually growing at 6%. Now, if the government reported inflation at that level, they'd have to pay out way bigger cost of living adjustments, especially for the 70 million Americans on Social Security. See, by reporting a lower number like 2.7%, they can get away with giving a smaller pay raise. And what does that mean? It means less money in the pockets of retirees who really depend on it. So, with all these conflicting signals, how are we supposed to make sense of the future? Well, a huge piece of this whole puzzle really comes down to just one thing. Who is going to be in charge of the Federal Reserve come 2026?
This timeline here shows you the key dates to watch. Jerome Powell's term as chair is up in May of 2026. It's very likely that his replacement is going to have a profoundly different approach to interest rates.
Right now, these are the three leading candidates to take over for Powell. You've got Christopher Waller, Kevin Hassett, and Kevin Warsh. And they all have one major thing in common. They are all in favor of much lower interest rates. So it seems like no matter who gets chosen, the general direction of policy is pretty clear.
So let's put it all together. When you combine the conflicting data, the official statements, and this big upcoming leadership change, well, the outlook for 2026 starts to become a lot clearer. It really looks like a significant policy shift is on the horizon.
And that shift will probably unfold in 3 main steps. First, a new chair who's in favor of rate cuts gets confirmed. Second, you'll see policy pivot hard towards lower interest rates. And third, fighting inflation is going to take a backseat to stimulating the markets and managing the national debt, which in a nutshell means creating money to pay for government spending.
And ultimately, this is the real key takeaway, that fundamental conflict, that tug of war between trying to control inflation on one side and trying to stimulate the economy and manage debt on the other, that's not going away. In fact, this tension is probably going to be the single most important factor that defines American monetary policy for the next several years.
Thanks for watching this video overview on 15 Minute Investor.